Welcome back to the Deep Dive. It is Saturday, January 31st, 2026.
And we're right in the thick of earnings season.
We are. And if you're the kind of person who checks your stock portfolio over breakfast, well, today might be a day to either, pour mimosa.
Or maybe just keep that app closed.
Exactly. It really depends on whose team you're on. Because we are not looking at just any reports today. We have the Titans.
The absolute heavyweights. We're talking about Apple, Meta, and Tesla.
And usually, when we talk about these three, we put them in these nice, neat little boxes. Apple's the hardware company.
Meta is social media, Tesla, cars.
Right. But I spent the morning reading through the stack of reports you sent over, and I have to say, those boxes feel completely obsolete. It feels like they're all playing the exact same
game now, yes. They've all converged on one massive, incredibly expensive theme, the age of AI.
The age of AI.
But what makes this moment, January 2026, so critical is that we've moved past the hype phase. We're not just looking at PowerPoints and promises.
Yeah.
We are officially in the bill comes due phase.
The cover charge to get into the club has gone way up.
Drastically. And to understand who's actually going to survive this shift and who is just, burning cash, we're looking at three specific documents.
Okay. What do we have?
We have a Goldman Sachs review of Apple's fiscal Q1 2026, then another Goldman breakdown. This one's on Meta's Q4 2025, and then a UBS report on Tesla that, well, let's just say it paints a very different picture.
So the mission for this deep dive is to figure out the ROI. Who's spending this money and getting rich now, and who is spending it and just hoping we don't go broke before the future gets here?
Exactly. It is entirely about the timeline of the payoff.
Let's start with Apple. Because for the last, 3, maybe 4 years, the narrative has been painfully consistent.
Oh, yeah.
Innovation is dead. The iPhone is a mature product. Nobody upgrades anymore. I feel like I read that same op-ed every single September.
And every single January, the earnings report proves it wrong. According to this Goldman report, reports of the iPhone's death were, once again, premature.
So they beat.
A significant beat. They hit an earnings per share and EPS of $2.84. The street was looking for $2.66.
That is not a rounding error. That's a genuine beat. But I have to ask, is it just services? Are they just selling more Apple TV? Or are people actually buying the hardware?
It is the hardware. iPhone revenue specifically grew 23% year over year.
23% for a product that old.
It's startling, and the report makes it clear this was driven almost entirely by the iPhone 17 family. The demand is it's significantly outpacing all the analyst models.
I want to drill down into where that demand is coming from, because I saw a stat in the notes about China that stopped me cold.
The China question? Right.
Yeah, we've been told for months that China is a doomsday market for U.S. tech right now.
Local competition, geopolitical tension, the works, usually the bearish argument. But you saw the numbers.
The numbers are insane. Apple revenue in Greater China didn't shrink. It didn't stay flat. It exploded. Up 38% year over year.
30%.
In this climate, how is that even possible?
It just defies the macro trend. And Goldman dug into the why, which is fascinating. It's not just existing Apple users upgrading, though there were record numbers of those.
So the switchers.
It's the switchers. They saw double-digit growth in people ditching Android to buy an iPhone 17.
Now that is the metric that matters.
Yeah.
Retention is one thing, but conversion is hard.
Mm.
If they're pulling double-digit switchers in a market like China, that says something huge about the product.
It's a serious flex. It suggests that whatever AI Siri features they're marketing are resonating enough to overcome that home field advantage of the local brands.
Okay, but here's the flip side, the reality of 2026. When you grow 38% in a place like China, you break things in your supply chain. I'm seeing notes here about supply constraints. Is this the usual stuff like shipping dates slipping a week, or is it more structural?
This is structural, and it gets a little technical, so let's unpack it. It's all about the silicon.
The chips.
Apple is hitting a wall on 3nm advanced node SoCs.
Okay, let's decode that. 3 nanometers, 3 nanometer.
Right. It's how small the transistors on the chip are. The smaller the number, the more power you can pack in, and these systems on a chip, the SoCs, they're the brains of the iPhone.
And they can't make the brains fast enough.
They're selling so many iPhone 17s that they literally cannot manufacture them fast enough. It's a bottleneck at the foundry level.
Wow, and the consequences are rippling out, right? I saw something about the future roadmap.
This is the scoop from Goldman. They are predicting Apple will have to push back the launch of the iPhone 18 base model and the iPhone Air 2.
Whoa, they usually run like a Swiss watch. September is iPhone month. It's like a holiday.
Not this time, potentially. Goldman thinks the release gets pushed from fall 2026 all the way to spring 2027. They simply have to manage the chip allocation.
So even Apple, the biggest buyer in the world, has to wait in line.
They have to wait in line. It just highlights how tight the supply for these high-end AI chips really is.
You mentioned AI Siri. We keep saying this is the age of AI. Is Apple actually spending money on this, or is it just marketing? Because they're usually so disciplined with their spending.
They are definitely spending. There's a little financial clue buried in the OPEX lines of the report.
OPEX, operating expenses, the day-to-day cost of running the business.
Right. And usually after the holidays, so in the March quarter, Apple's OPEX goes down or stays flat. It's seasonal.
But not this time.
This quarter, for the first time on record, OPEX increased quarter over quarter in fiscal Q2.
That is a signal.
It is a loud signal. Goldman points out this is specifically to support AI Siri and the new product pipeline. They are hiring, training models, burning cash on R&D.
So it's a put your money where your mouth is kind of situation.
It is, and Goldman actually views this as a positive. They say it increases the likelihood that AI Siri will actually be, good.
Okay, so that's Apple. Selling hardware, constrained by physics, but printing money. Let's pivot to the company that seems to have no constraint on spending whatsoever. Let's talk about Meta.
The Meta report is. Honestly, it's just staggering.
I remember 3 years ago, everyone was writing Meta's obituary. The metaverse is a money pit. Zuckerberg has lost it. Now I'm seeing AI superintelligence in this report. Has the narrative just shifted, or has the business really changed?
The business is firing on all cylinders. Revenue beat with 23% growth, FX neutral. But the really interesting detail is specifically about WhatsApp.
The app everyone uses, but no one pays for.
Until now, click-to-WhatsApp ads revenue grew 50% year-over-year in the U.S.
50%. Explain how click-to-WhatsApp actually works.
It's a direct response ad. You see an ad on Instagram, you click it, and boom, it opens a WhatsApp chat with the business.
Instead of a website.
Exactly. You can ask questions, book an appointment, buy something right there. It just closes the loop instantly.
So they finally monetized the messaging giant. That's huge. But, and there's always a but with Meta the cost. I looked at the expense section of this Goldman report, and I genuinely thought it was a typo.
It is not a typo. It is the sticker shock of the century. We have to talk about CapEx, capital expenditures.
The money for physical assets, data centers, servers, all those expensive GPUs.
All of it. Now, you want to brace yourself for the number.
Give it to me.
Goldman estimates that for fiscal year 2026, Meta's CapEx will hit roughly $132 billion.
Excuse me. $132 billion in 1 year.
In just 1 year. That is an 83% increase year over year. And if you add in everything, their total expenses are estimated around $166 billion.
That's larger than the GDP of entire countries. I mean, Morocco, Kuwait, why? What could possibly justify burning that much money on servers?
This is the core argument of the report. It's the scaling effects of AI.
Okay, what does that mean in plain English?
It means that unlike the metaverse, which was a speculative bet on a future that might happen, the spending pays off today. The more compute they throw at their AI models, the better their ad algorithms get.
So the $132 billion goes in, the algorithm gets a tiny bit smarter.
And ad revenue jumps 23%. Precisely. It's a machine. Put money in for chips, get better ads, get more cash out. It's this virtuous cycle.
So it's not all speculative.
Not at all. But they aren't just doing ads. Management was very explicit about funding the Meta Superintelligence group.
Which sounds like a villain organization from a James Bond movie.
It does a little bit. But they're building new foundational models. They want AGI, artificial general intelligence. So a huge chunk of that cash is trying to build the next generation of computing.
And are we still paying for the old dream? Reality Labs? The VR stuff?
Well, absolutely. The furnace is still burning. They lost about $6 billion in Q4 alone on Reality Labs.
$6 billion. In a quarter. Any other CEO would be fired for that.
Probably. But when your core business is printing that much money, thanks to AI, investors tend to look the other way. Goldman has a buy rating, target of $835. The logic is the apps subsidize everything else.
Fascinating. So they're spending a fortune, but making a fortune. Now let's cross the tracks to our third giant, Tesla. I'm looking at this UBS report, and the vibe is entirely different.
It's night and day. UBS has a sell rating on Tesla. Their price target is $352. That implies a significant downside from where it was trading.
A sell rating on a major tech stock in a bull market. That's a bold call. Why are they so
It,
bearish?
it comes down to an identity shift. UBS says Tesla is no longer just an EV company. They are pivoting hard to become a physical AI company.
Physical AI sounds like great marketing, but what does that mean for the balance sheet?
It means big goals require big cash. That's actually the title of the report. And UBS warns that Tesla is entering cash burning mode.
Wait, I thought Tesla was profitable now.
They are on an accounting basis, but their cash flow is flipping. UBS forecasts Tesla will burn about $6 billion in cash in 2026. Their CapEx is doubling to around $20 billion.
20 billion. Where is that going if they aren't building a new car model?
The infrastructure for autonomy. 6 new factories and these massive AI compute clusters. They've got the Cortex cluster, Dojo, Memphis. These are giant supercomputers just to train neural nets.
So they're buying thousands of chips, just like Meta.
Exactly. But here is the problem UBS highlights: the timing of the payoff.
Explain that.
When Meta buys a chip, they use it to show you an ad today and they get paid today. When Tesla buys a chip, they use it to train a robotaxi that might make money eventually.
Let's talk about that Robotaxi because the report says it's actually live now.
It is. And this is where the sell rating clashes with this sci-fi reality. The Robotaxi is now operating in 7 cities: Austin, Dallas, Houston, Phoenix, Miami, Orlando, Tampa, and Las Vegas.
Operating how? With the person in the front seat just in case.
No, this is the critical detail. They are operating with no safety monitor.
No human in the car at all.
Just the car. From a technical standpoint, that is a massive milestone. It proves the software actually works.
And what about the robot? Optimus?
The Optimus V3 unveiling is imminent. But the wild part is the manufacturing plan. Musk wants to turn the Fremont factory, the original EV factory, into an Optimus factory.
You build robots instead of cars.
The goal is to produce 1 million robots a year.
1 million humanoid robots a year. I mean, if they pull that off, the company's worth 10 times what it is now. So why is UBS saying sell?
Because of the stretched out S-curve? It's a timing mismatch. Tesla is spending the cash now. The $20 billion leaves the bank in 2026. But the revenue from Robotaxis and Optimus won't be material. It won't really matter until 2027, maybe 2028.
So investors are being asked to fund a massive cash burn for a payoff that's years away.
Exactly. The valuation is high because people are dreaming about 2028, but the financials for 2026 look like a construction site. You are pouring money into a hole and nothing is coming out yet.
Okay, this brings us to the synthesis. We have 3 companies: Apple, Meta, Tesla. They used to be in different universes. Now looking at them side by side, what connects them?
If we zoom out, the first commonality is just the sheer scale of the bill. We can call it the AI Ante.
If you want to sit at the table, you have to put 20 billion in the pot.
Minimum.
Yeah.
Apple is breaking its own OPEX rules. Meta is spending $132 billion. Tesla is burning its cash reserves. The era of the asset-light software company is just, it's dead.
Yeah.
If you aren't building physical data centers and buying physical silicon, you aren't competing.
And that leads to the second commonality, right? They're all fighting for the same limited resources.
The supply constraints. Apple is delaying the iPhone because they can't get enough 3nm chips. Tesla is talking about needing 100,000 wafers for their training clusters.
A wafer being the silicon pizza the chips get sliced from.
Exactly. And there's a physical limit to how many of those TSMC can produce. So even with hundreds of billions of dollars, these companies are all waiting in the same line.
So we've moved from a world of infinite software scalability to a world of finite physical constraints.
We have.
But the distinction, and this is what I want you, the listener, to really grasp, is the difference in risk.
That is the crucial takeaway. We have 2 different business models emerging.
Break them down for us.
Okay, first you have the AI tax model. That's Apple and Meta. They're spending huge amounts, but they're passing that cost onto the consumer immediately.
So,
Apple sells the iPhone 17 now for a profit. Meta sells the more effective ad now for a profit.
Okay.
Their core businesses are such powerful money printers, they can fund this whole AI habit without asking investors for patience.
and the second model.
The Moonshot model, that is Tesla. They are trying to invent a completely new physics-based economy. They're not just making the Model Y a little better, they are trying to replace human labor with Optimus and human drivers with Robotaxi.
Which is infinitely harder.
It's exponentially harder. Physical AI has to deal with rain and pedestrians and gravity. Digital AI just has to predict the next word in a sentence. Because Tesla's challenge is harder, the timeline is longer, and the cash burn is, well, it's a lot scarier.
It also seems like there's a different flavor to the AI they're all building. It's not the same brain.
That's a great point. Apple is winning on consumer, on-device AI. It's personal. It's in your pocket. Meta is winning on digital algorithmic AI. It's about content and commerce. And Tesla is pretty much alone in the physical realm. They're putting the brain into a machine that actually moves through the world.
So for the person listening, maybe holding these stocks or just watching this all unfold, how should they think about this year?
Well, it raises a provocative question about what a tech company even is anymore. We grew up thinking of tech as two people in a garage writing code. Low cost, high growth.
The classic startup story.
Yeah.
Sell for $1 billion with 13 employees.
That era is over. In 2026, capital intensity is the new mode. If you don't have $50 billion to spend on compute, you can't even play. This entrenches the giants. But for an investor, you have to decide, do you want the company paying for its revolution with today's profits? Or do you want the company betting its entire existence on a breakthrough that hasn't fully paid off yet?
The safe bet versus the world builder.
And remember, even the safe bets are subject to the laws of physics. If Apple can't get the chips, the phone doesn't ship. It's a fascinating and I think a very precarious moment for all three of them.
Well, I'm definitely going to look at my iPhone 17 a little differently now, knowing it's fighting for silicon against a Robotaxi somewhere.
Yeah.
And speaking of which, if you see one in Vegas with no one in the driver's seat, maybe give it a little extra room.
Definitely.
That is it for this deep dive. Thanks for listening, and we'll catch you next time.